India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Tuesday morning, and will today be the day when sometime during the course of the session we are basically back at the last all-time high. We're not very far away. I think, 50-odd points, 60-odd points, and we are there. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning. So I think we've got a lot going on. Geopolitics making all kind of headlines. Not too much change by way of yields or, overnight action in terms of fresh macro cues from the US. Yeah. But hey, we're 70 points off, just under 70 points off from that milestone. What do you say, Nigel?
Well, indeed, yesterday it gave you the sense maybe in the final 60 minutes we could see that flurry. It didn't take place, so maybe today's the day.
Yeah, the start is indicating a slightly lower, neither here nor there kind of a thing. But I mean, if the market is going to do what it has always done, which is
buy the dip
at some point, I mean, today could be the day. Well, the point is, it's kind of it's not as if we're coming back to these highs after 3 or 4 years. We were there practically recently, and you're just sort of reclaiming some of those levels. So that excitement is there, but you've got to have much higher levels for some real excitement to come back. But in any case, not a bad sign at all to look at the previous highs sharply in focus, a point we've made for the last at least 5 or 6 trading sessions now. So let's just sort of begin with that. The Nifty is almost back at new all-time highs. In terms of a record close, we almost got to, I think, within 1 point of it. In terms of closing, all-time high, as we've been saying, 50-60 points higher. The high is 25,078. We left off at 25,000 and 10-11 yesterday. Now, overnight, you might look at the US session and say markets are down, and they are about 1/3% down on the S&P. Nasdaq is down about 0.8. But consider this: it was the lightest volume session in the US markets for all of 2024 last night. In light markets, it's very one should not make, or rather read too much into moves and big moves. This is not a big move, but I think, for example, the semiconductor index sold off yesterday. Nvidia was down 2.5%. We'll come to that in just a bit. But light markets, I don't think should be read into too much. That's essentially the point. I think look at this as just a bit of a drift and nothing more. Now, US 10-year yield was about 2 basis points higher. We're back at about 3.82. Nothing. The dollar index is close to about 101. A slight bump. You had basically Fed's daily who questioned labor market weakness last night. I mean, it was not as if it was a marked difference as compared to what we heard from Powell at Jackson Hole. But she did kind of make the point that she doesn't want to declare that the Fed is on the path to neutral rates just yet. That, they're most definitely on the path to easing. She doesn't see the labor market as being too troubled. And I think post these comments is when yields made a bit of a move and the dollar saw a bit of a bump. Now, of course, geopolitics is very much the name of the game, both in the Middle East and, of course, between Russia and Ukraine. And, both seeing sharp escalation on 2 different fronts over the last 24 and 48 hours. Oil prices, as a result, have moved up a little bit more. Last night, they went up almost 3%. We are back above $81 a barrel. I think from recent lows of about 76 and a half, we are back above 81. Now, tomorrow night, you get the NVIDIA results. And that's essentially the Pied Piper for the entire AI story. The AI story is not a one-way story now. There is, pull and push, and a lot of people kind of questioning the economic implications, at least in the near to medium term. Long term, no one disputes, but there is sort of pushback coming into this as well. And of course, NVIDIA has got its own issues with that Blackwell chip the launch getting delayed, etc., etc. And this could be material for US markets because so much of what the US has done is because of semiconductors and led by NVIDIA especially. Now, just to come back to the levels here, for the Nifty, of course, I mean, the all-time high is in view, and that'll be the first target in that sense. Above that, you look at a simple Fibonacci retracement level, which comes in at about 25,530. So that's a level after we cross and close above the previous all-time high. That's a very near term. We can sort of look at this in greater detail. Support for the Nifty comes in at 24,780, which is the hourly average, and then the 20-day moving average, which is far below at 24,550. Bank Nifty yesterday closed around the falling trend line of 51,150. We left off at 51,148, so practically there. And a decisive move above this trend line, which is a falling trend line, Bank Nifty can target the upper daily Bollinger Band, which is at about 51,867. Support for the Bank Nifty comes in at the swing low, which is 50,856. GIFT Nifty indicates, I think, about a 20-25 odd point lower starts, which is, as I said, neither here nor there. And I don't think there is too much to be read from what happened overnight from US markets. So it's entirely possible that, after maybe a flattish start, we quickly bump up and at least touch that sort of last all-time high at about 25,078. Surbhi.
Absolutely. I mean, I'm looking at the Asian screens as we speak, Prashant, and it's just to see a Fred out there because there is some caution, there is profit-taking that's going on. Whether you're looking at the Hong Kong markets or Shanghai right now, down 0.25%, Kospi, I mean, the whole lot, Japan, everything's down. It's not a slide, but yes, there's lots of profit-taking going on across Asia, which is why the GIFT Nifty is indicating that it will probably start off on a cautious note. Now, in terms of, the focal points, all that's happening around geopolitics suddenly is sort of back center stage, and we're talking several flashpoints. There's obviously what's happening between Israel and Hezbollah trading rockets, and then yesterday we had headlines out of Ukraine and Russia, with Russia targeting some of the oil infrastructure in Ukraine. And if that wasn't enough, now there's a third angle to it, because yesterday there was some chatter about Libya looking at shutting down a large part of their crude output, and that could, I was reading somewhere, I think, could easily, if all the output goes, it could take 1 million barrels off the market immediately. So there's a lot of rhetoric. I mean, those are internal issues in Libya ongoing, but the oil market really took note of Libya because of the extent of impact, direct impact on oil supply that could take place. So that led to that big surge both on NYMEX and Brent oil. In fact, even this morning, I mean, Brent, yesterday when we left off, remember we started the week with Brent around 79. As we were closing, we were at around 80. And this morning, the prices climbed to above 81. So that escalation is something that we need to really watch out for. Remains a bit of a spot of bother. Yesterday, of course, as Prashant mentioned, not too much out of Wall Street action, but that sector rotation is very, very interesting. For no apparent reason, the fall in tech is something that the market really took note of. Even the Dow couldn't hold at the all-time highs that it hit. Apart from NVIDIA, the other interesting facet is going to be Apple. Apple's event, of course, that annual, fall event that they do where they unveil newer models of their products. That is slated for the 9th of September. But beyond that, the change in the CFO is something that's got the market's eye as well. The old CFO, Luca Maestri, he's being moved out. He's still in the company, but in a different role, and he's being replaced with Kevin Parekh, who's of Indian origin. So that remains sort of a point to track as well. Looking at flows back home, well, the situation is that FIIs, at least they weren't on the sell side. We had a mild buy figure, about 500 crores of a buy figure. Domestic institutions bought equity worth about 1,900 crores in the cash market. The Nifty, as we've been discussing, less than 70 points away from the all-time high, but the start is going to be cautious given the global cues. Will the buy-on dips play out is what we're going to see. Given what's happened on, NASDAQ overnight and the fact that IT rallied yesterday, I'm expecting some profit taking on IT as we start, but then let's see if that dip gets bought. And the big, big question is going to be whether banks can provide that ammunition, whether they can step in and do some heavy hitting, the heavy lifting, so to speak, because that's where the performance has been patchy in the last couple of days, Nigel.
Well, that's right. I'll take it off from there then, Surbhi, because the Nifty Bank, that's the one that's going to be the trendsetter. That's in a bit of a range. If it can break out of the range, then that'll be actually good news. So today we'll have the Nifty Financial Services Index that plays out the options as well as the futures expiry. So that's going to be a mover in the second half of trade. The Nifty uptrend, I would say, is intact. The 20 DMA is held. This uptrend is well and truly, continuing. The Nifty Bank, that's been a bit of a range. That needs to move out of that range, and that's what will give us direction from there on. What about the FI positioning? Yesterday, they added some long positions, close to around 17,000 long contracts, and they covered close to 15,000 contracts, which explains why we went from 25,000 long positions to around 57,000 long positions. So the FIs, they are net long. In fact, the net long positioning is the highest we have seen all the way since 7th of August. So that's the data point on the FIs. The clients, well, they booked some profits because the long positioning, well, it did come down a little bit. The FIs as of now, 55% is the long positions as of now. That as well is at a couple of weeks high that we have seen. The client's positioning should come up for you on the screen. Yesterday, from around 34,000 contracts, it came down to around 16,000 contracts. So they unbound some long positions, which is par for the course. That's about the FI and the client positioning. What about the options data? 25,050 call, that was extremely active in yesterday's trading session, and the 25,000 put. So plugging in these numbers, you get a broad range. You have these contracts that will expire on Thursday itself. So the levels to track, as I said, the 20 DMA, well, that's the important marker on the downside. That's the crucial support. And till that's held out, you'll see that the uptrend is well and truly on. Yeah, the highs that we saw at the start of August and the all-time high is at around the 25,078 mark. We couldn't get to there. So that's going to be the level that you're watching on the upside. The Nifty Bank, that's the mover, that's the important mark. Yesterday as well, we made this point, 51,300, 51,400. That's a bit of a resistance zone. And that's part in line with where the 50 DMA is at. You have support coming at the 20 DMA, but that's the important mark, which is at around that 51,400 odd mark on the Nifty Bank. As I said, the financial services index will play out the expiry. So that's going to be the mover in the second half of trade. The stock I'm looking at is a stock from the cash market. We're looking at Gillette. Yesterday, Gillette moved very, very well. And in the last 1 year or so, it's moved from around 5,000 rupees closer to around 9,000 rupees. So, and this big surge has come in the last few days as well. Keep in mind, it's come on very, very large volume. So Gillette is a stock that I'm looking at. They have their results that they report in the next couple of days. And this big surge was backed with solid delivery-based buying as well. It has its results. Is the street sniffing something? I'll tell you what, from 2019 to 2020, the stock was a big underperformer, but it seems to be breaking out of a range. So we'll keep an eye out on this stock as well.
All right, Nigel, thank you very much for that. So keep an eye out on that name and, of course, a range of factors which will be at play today and over the next couple of sessions. James Knightley is Chief International Economist at ING. He's joining us now to take some questions. James, good to have you with us here. Thank you very much for your time. The point is markets both in the US and India, which are perhaps the two large best performing markets over the last couple of years, continue to knock at all-time highs, despite, of course, the slight cut last night in the US. Here in India, we're very close. I mean, I think 50 basis points, less than 50, 0.5%. What is your sense, James? I mean, is the setup overall positive? Could oil play a bit of a dampener? Or do you think geopolitics is unlikely to influence stock markets at least?
I think in the near term, we're all obviously very focused on what's happening to the US interest rate cycle as the next clear driver of where markets are going. I don't think, we're going to be progressing onto the US election in time, but for now, it's this US rate cycle. And we've got, say, 3 key data points between now and September the 18th. And if we get ongoing low inflation, we're going to get an inflation print this Friday. We're going to get another inflation print on September the 11th. And of course, it's the all-important jobs print on September the 6th in the United States. And if we do get a cooling jobs market, low inflation, then the market's anticipation of interest rate cuts and a soft landing, which is the ideal scenario for equities, this soft landing scenario where the economy continues to grow, we avoid recession, but we get a lower interest rate environment too, can really progress the strong narrative that the US markets can continue to outperform. There are obviously clear risks to that, and Jerome Powell laid that out last Friday at his Jackson Hole appearance, where he said, basically, we cannot tolerate any further labour market weakness. The Fed are clearly very concerned that the labour market is in a weaker position than it was in 2019. And if they don't take action, then they could see the economy slip away in terms of growth more rapidly than perhaps the equity market is currently anticipating. So I think it's a delicate balance right now. For now, the markets are in the optimistic soft landing scenario with lower interest rates. But as I say, the risk is that perhaps the Fed needs to step on the gas in terms of rate cuts if the jobs market is weakening, and that prompts broader weakness in the US economy.
Sure. James, hi, good morning. Great to have you on the show. The other point that my colleague Prashant just raised, geopolitics. What do you think, what kind of a risk could we be potentially looking at? I mean, so I think the Fed rate cut issue is behind the market. Everyone's expecting at least gradual cuts from here on and, that Goldilocks soft landing. But could commodity prices be the next surprise given what we're hearing and what we're seeing all around?
Yeah, I mean, there's certainly geopolitical risks out there. I guess mitigating against that in terms of a market and a macro economy is if we look at Europe, Europe has been incredibly successful at building its gas stocks, its natural gas stocks. They're about 90% of capacity, well ahead of schedule. So from that perspective, the European economy is perhaps a little bit better insulated than it could have been in previous years. So that's a positive. But also, I guess, offsetting some of the geopolitical concerns is worries about China. The Chinese growth story isn't looking particularly robust right now. And we're going to get more of these Chinese business surveys, these purchasing managers indicators later this week. And they're expected to be flat to in contraction territory. And that could perhaps limit the upside on some of the commodity market moves. If you are in the camp that believes that the China slowdown coupled with a cooling US economy is going to offset some of these upside pressures from geopolitical tensions.
Hi, James. Morning and good to have you on the show. This is Nigel on this side. I wanted to ask you about the expectations from central banks. From the Fed, I think you were hinting at multiple rate cuts this year. So how many are you penciling in? And from the Bank of Japan, that caused a bit of a scare with that rate hike. Do you think bulk of that yen carry trade has been done?
Yeah, no, it's an interesting point. So we've got about 100 basis points or a full percentage point of rate cuts priced for this year over the next 3 meetings. And I'm pretty much in line with that. I think we could well get a 50 basis points in there with 225 basis point cuts, largely because I think there is scope for catch up from the Fed to the economic position that the US finds itself in. And I think, the market's looking at another 1.25 percentage points of cuts next year. And again, at this point in time, I don't have enough to really disagree with that. I think, Fed getting down to a more neutral level makes sense. Inflation is converging on target. So, yeah, I think multiple rate cuts, a whole series of rate cuts, 25 basis points, the typical outcome, but I wouldn't be surprised to see a 50 at some point this year. So that's the course for the Fed. And we think that will generally lead to a bit more softness for the US dollar. But in terms of the yen, the Bank of Japan did raise rates 15 basis points. That was viewed as a catalyst for some of the market volatility we saw a few weeks ago. I think that was a bit overplayed. Japan raising rates 15 basis points really doesn't do that much to the global economy, to be honest. And we think that, given the commentary we've had from the Bank of Japan governor recently and more of the research papers coming out of the Bank of Japan, they seem pretty behind the view that they need to raise rates further. Wage pressures are building, and there's a bit more sense of corporate pricing power. So, yeah, I think, we could see the yen continue to perform better, actually.
Oh, okay. All right. Well, live in interesting times, as you're saying. Let's see how the data shapes up going ahead in the US, in China, and of course in Japan. Good talking to you today, James. Thanks very much for making time for this conversation. Well, let's quickly move on and kick it off with the equity call of the day. Rupal Agarwal of Bernstein says that in 2024 so far, most Asian markets have displayed similar trends as the US, i.e. large caps outperform relative to small caps, except for India and Taiwan, where the market rallies have been led by small and mid caps. She says within Asia, they see Japan and some ASEAN economies showing positive growth trends, presenting a good setup to pick small and mid-cap stocks. She adds that India is the only Asian market where small-cap leadership has persisted, and in the near term, earnings trends are still supportive. However, she says large caps relative to small caps are now near record low relative valuations and crowding levels in India, warranting selectivity towards small and mid-caps and increased exposure towards large-cap names.
All right, well, this is Abhishek Goenka of India Forex and Asset Management, who says that the dollar is weakened following Fed Chair Powell's indication at the Jackson Hole Symposium that a rate cut cycle is likely to get underway. He says dollar index has dropped to the lowest levels since July of 2023. Consequently, he says GBP INR, which is the British pound INR currency pair, has approached 111 mark, and the Euro INR pair is close to the 94 mark, both record highs. He continues to expect the rupee to underperform amid broad dollar weakness, but now to a lesser degree than what we've seen so far. He expects the currency, the dollar INR, to be between 83.4 to 84.4 to the dollar over the medium term.
On to bonds then. Vishal Goenka of IndiaBonds.com says bond yields remain mostly unchanged globally yesterday, post the Friday statement by Jerome Powell on U.S. rate cuts starting in September. He says it is important to watch oil prices, which have rallied 6.5% last week on geopolitical tensions in West Asia. Domestically, he's expecting corporate bond issuance to pick up in the next month ahead of the first half of FY25. As the markets remain stable, he's expecting the 10-year benchmark bond yield to trade in a range of 6.83 to 6.88%.
Well, a lot of stock-specific action to track for you. We'll get to that in just a bit. But for the time being, let's run you through the list. We're looking at MediAssist, Segal India, Zydus Life Sciences, HCL Tech, Forge, Brainbees Solutions, Bilibili, and MedPlus Health. All of them will be reacting to positive news flow, while you have GPT Infra and AU Small Finance that could be reacting to negative news flow.
All right. Well, we'll take a quick commercial break here. Our list of top stocks with our research team is lined up next. Stay tuned. That's coming up in just a bit.
Welcome back. So as we've been telling you, the start is likely to be a little on the cautious side because of the red across the Asian screens. That's the implied open, about 14, 15 points lower. But lots of individual stocks in focus as always, and we have our team standing by with the CNBC-TV18 list of top stocks to watch. Let's kick it off with some M&A then. MediAssist in focus because it's snapped up another company. Yash, good morning. Tell us the details.
Well, it should be the largest transaction as far as the TP or the third-party administration space is concerned. MediAssist has acquired Paramount TPA. Now, the enterprise value for this particular company is at about 312 crore rupees. Estimated equity value for Paramount TPA goes to about more than 400 crore rupees. Now, as far as Paramount TPA is concerned, it's slightly bigger than the previous transactions which MediAssist has done, and hence comes at a higher valuation as well. Paramount TPA is about 2.5 times sales versus Raksha TPA, the company which MediAssist acquired previously at 1.7 times sales, and MedVantage at about 1 time sales. But importantly, what does Paramount TPA bring to MediAssist? It is the largest TPA in the group segment as on FY24. The acquisition will take MediAssist to have a total market share in the group segment to 36.6% and in the health insurance segment to about 23.6%. So fits in well with what the company wants to as far as the group business is concerned, takes the company to a higher market share and accretive to EPS for the company that is MediAssist as well.
Okay, thumbs up there. Thanks a lot for that, Yash. Well, let's hop across to Vivek. He's tracking a few companies. Hi, Vivek. Good morning. Take us through the list.
Good morning. So, two companies first on my radar. GPT Infra Projects, companies looking to raise close to 175 crore. This is via the QIP route. Base size for this particular deal is 150 crore. The upsize option the company has is another 25 crore. The indicative floor price for this particular transaction or the fundraise is at 174.6 rupees a share, almost 6.5% discount to the current market price. Motilal Oswal is the sole broker to this particular deal. The other stock on the radar is Segal. Now, it's a recent listing. The company has just come out with its Q1 numbers. A good set of numbers from the company this time around as well. Revenues high by almost 26.5%, coming in at close to the 823 crore mark. EBITDA high by 65% on a year-on-year basis at 144 crore. Margins at 17.5%, a good margin expansion seen over on a year-on-year basis as well. Profitability high by 80%. Where does the order book stand? At the end of or on listing day, the company said that they had an order book of close to 9,400 crore, 80% which were linked to NHAI projects. Company also said that they've bid for 16,000 crore worth of projects. So it'll be interesting to see, as details emerge, what is the current order book and what is it that the company is guiding for.
All right, Vivek, thank you very much for that. So that is basically some news related to names, but more. And there is the list. Vamakshi is here with that one. Vamakshi, good morning.
Well, absolutely. Good morning. Let me first start off with Zydus Life Sciences. The company has issued clarification report with respect to increased competition for Asacol HD generic. They have highlighted that the impact has already been factored into the sales as well as the EBITDA estimates for FY25. They've also guided for an improvement in the consolidated EBITDA margin by around 150 basis points for FY25, and this is as compared to EBITDA margin of nearly 27.5% that we saw in FY24. They're estimating high teens consolidated revenue growth to also come through this year. And given all of those factors, going with the green for Zydus Life Sciences. HCL Tech is the next stock on our radar, and that is because the company and Xerox have extended the agreement to drive innovation with AI and digital innovation. Partnership between the company and Xerox had started back in 2009, and under this partnership, HCL Tech will deliver a unified interface that transforms the way employees and clients engage with Xerox. HCL Tech will leverage automation, product engineering, and process operation services to digitally transform Xerox. So going with the green for HCL Tech. Coforge is the next counter that I'm tracking, and that is because Motilal Oswal funds have acquired an additional 1.91% stake in the company, and with this, the total stake in the company has risen to 5.42%. Brainbee Solutions also expected to open higher after SBI MF under various schemes has acquired 4.5 lakh shares. With this, its stake in the company has risen above the 5% mark. And lastly, let's also focus in on Dilip Buildcon. The arbitration tribunal has pronounced an order in favor of the company. The award relates to arbitration of company against the Public Works Department (BNR) in Punjab and pertains to construction of Dharamkot bypass in Punjab. NHAI under this award has been asked to pay Dilip Buildcon for 16.65 crores. Interest may be levied in case of non-payment. So overall, given this arbitration award in favor of Dilip Buildcon, going with the green for this counter.
Okay, all right. Thanks for that, Vamakshi. Going back to Vivek, then he's tracking a couple of companies that saw large trades yesterday. Vivek, we know the buyers and sellers. Tell us more.
That's right. So post-market hours, the details are out, who sold and who bought. So two companies on the radar. First one is AU Small Finance Bank. Yesterday saw almost 1.7% equity change hands. So the seller, very interestingly, was FinCare Business Services, 1.7% stake. They sold at 630 rupees a share. Deal size at a little over 800 crore. Who is FinCare Business Services? It was the ex-promoter entity of FinCare Small Finance Bank. That was the company that actually merged with AU Bank. They continue to hold a little over 6% stake in the company. Amongst the key buyers was DSP Mutual Fund, picking up over 1.3% stake. Whole list of other buyers as well. MedPlus Health, yesterday saw a very large block deal in terms of the percentage of equity trading hands. So Warburg Pincus actually made a complete exit yesterday. Lavender Rose Investment, that was the entity under which Warburg held stake. 11.35% stake sold at 616 rupees a share. Whole host of buyers, top amongst them being ICICI Prudential Pharma and Healthcare Fund, 1.4% stake they picked up in the company in the block yesterday.
Okay, all right, got it. Thank you very much, Vivek, for all the details there. Lots of action there on plenty of individual stocks. So let's quickly recap that list for today. The stocks that have positive news flow around them are MediAssist Healthcare, Segal India, Zydus Life Sciences, HCL Tech, Coforge, Brainbee Solutions, Dilip Buildcon, and MedPlus Health. Stocks with negative news flow around them are GPT Infra and AU Small Finance Bank. Okay, beyond the news, what are the interesting brokerage notes to track this morning? Sudarshan standing by. He's been going through all that reading since the morning. Sudarshan, so what comes up on your screener? What's interesting today?
Morning, Survi. So we'll start with Avenue Supermart. CLSA has written on the stock after analyzing its annual report, and it maintains outperform call and raised target to rupees 5,650 from rupees 5,535 per share. It says company is gradually improving across the environmental and social metrics, and it's increased its focus on utilizing more solar energy and green building certification. CLA remains positive on the outlook for the stock as company remains a long-term cost leader in the Indian retail sector. Next is Morgan Stanley has written on real estate sector. It says investor interest in real estate has waned against what it was 6 months ago. Developers are launch dependent and valuations are looking stretched, but it remains constructive amid a continued upcycle. It believes pre-sales outlook for DLF, Oberoi and Prestige Real Estate could be slower. Godrej Properties is its preferred play. It says on an EV to EBITDA basis, Prestige Estates and Godrej Properties, both overweight rated stocks, look cheaper at current levels. Last is JP Morgan on Indegene. It initiates coverage with neutral call and target is rupees 570 per share. It says growth slowed down post-COVID from client-specific factors and weakening macro conditions, but it expects growth to bounce back to early teens from FY26. But it believes company trades at a premium to most tech operations companies and at the upper end of mid-cap tech services peers, and with full valuations and clouded visibility on new launch, it finds the stock fairly priced at current levels. That's the reason it initiates coverage with a neutral call.
Okay, thanks Sudarshan. Gone through a whole host of notes and filled us in with what all you have read. Well, let's move to Manisha then. She's here to tell us about the commodity space. Morning, Manisha. Plenty has happened overnight.
Oh, yes, it has. And if you look at the crude oil prices, we've gained 3% overnight. If you look at the last 5 trading sessions, the crude oil prices have gained up by $5 in 5 days. So even with this correction that we've seen in Asian markets right now, crude is trading on the higher side of the range. Well, there has been near total production stoppage in Libya. The escalating tensions between Israel and Hezbollah are equally supportive. And then the street is looking at the U.S. crude inventories, which are the lowest in last 2 years at this point in the year. The OECD data also shows that the global crude inventories are 4% below 10-year average. And with the Chinese demand slightly picking up now, that seems to be adding into the markets as well. And of course, the U.S. dollar index decline, the Fed rate cuts are data that has been supporting various asset classes there. Within the metals as well, this is going to be a strong August. We are looking at gold at near all-time highs. Silver, copper, aluminum are trading at a 5-week highs. Iron ore prices at one point in time crossed $100 a ton in the late New York session yesterday. So there is money coming back in many of these commodities.
All right, Manisha, thank you very much for that. Appreciate it. We'll take a quick commercial break here. We'll connect with Deepak Shenoy, founder at Capital Mine. It's a happy day for Deepak and his team at Capital Mine over there. And we'll tell you why if you've not been following him on social media. Stay tuned. That's coming up in just a bit. We'll talk specific stocks and his views on markets as well.
Welcome back. So as we've been telling you, the cues are a little iffy this morning because of largely geopolitics. I mean, overnight, yes, we saw a bit of a sell down in Wall Street, but that some will attribute to some profit taking, some will attribute to nerves before Nvidia's numbers. But what's happening, as I said, I mean, 3 different flashpoints now. So you've got Israel, Hamas, Hezbollah, that's 1. Then you've got Russia, Ukraine, that's 2. And Libya opened up yesterday as the 3rd flashpoint. And Libya is the most dominant factor when it comes to the oil market, straight impact on output. And therefore, we saw that, very, very rapid escalation in oil prices. And that's kind of weighing on markets to see how these 3 flashpoints settle and sort of move forward. But, let's come back home. And there was some very interesting news and happy news for Capital Mine. We've got Deepak Shenoy joining in. Usually we, start straight off with markets. But Deepak, this morning, first of all, congratulations are in order. It's a big day. It's a good day for you all, I think. 10th anniversary, and you get the approval to set up a mutual fund. So what's the feeling? What's the thought process? Congratulations.
Thanks so much, Survi. It's been 10 years since we started, and that's, of course, one part of the news. And we've been applied to launch, be a sponsor of a mutual fund. And SEBI has given us an in-principle approval. So now the bigger work begins on setting it up and creating it. So it's an extension of what we do. We are a portfolio manager, so we actually manage money for customers. So in that sense, it's the same job, it's just in a much bigger way. But I think, excited because a lot of opportunities open up. And also, very challenging work. So the regulatory interface just goes up 10x more. So good times, crazy times. Sorry, thank you.
I can completely understand. And, yesterday I was going through that press release that, you folks had put out. I couldn't help but thinking this is fantastic. Because we know you as someone who's very, very investor-centric, right? And that's what I think a lot of investors would want to see from the offering from Capital Mine. But I couldn't help but think that isn't this getting to be a very crowded marketplace? Setting up a mutual fund, competing with the big boys with, thousands and thousands of crores in AUM, with the regulatory onslaught, as you mentioned. So from a business standpoint, I mean, how does it make sense?
Oh, I think there's always going to be space for more. There's the market itself is about 48, maybe less than 50 mutual fund houses. And of that, it's only the top, I think, 20 that dominate. The 25th mutual fund has only about 15 or 16,000 crores as of December of last year. So it's not like this is a winner takes all. I think there is a lot of growth. India's total market is about 60 lakh crores, which is about, I think, roughly 18 or 19% of GDP right now. I think going forward, we should see this number go up to 50% of GDP. Close to 50% of GDP. Even if it became 30% of GDP, we'd go to 1.25 lakh crores. I think there's enough space for a lot of players. We are going to be small for the coming few years for sure. I don't think we're going to be in any way a threat to any of the big boys.
Well, at least not right now. But Deepak, congratulations. And what a journey, right? Inspirational, actually. I mean, it started with a blog. And then, PMS, AIF, mutual fund. So the important question is, where is the party?
Anytime. I think we'll give parties when we actually get a final approval, because this is like it's like celebrating too early if you're celebrating just in principle. Yes.
But strength to you and all the best to you and your team. It's really inspirational. I mean, to you and the team, which has sort of built this from scratch. Actually, literally from scratch. Deepak, let's talk about markets in that sense. The story is domestic liquidity, which is, of course, what as an entrepreneur you're betting on as well when you start that mutual fund. And that's pushing markets to, I think, new all-time high. Hop, skip and jump away. What's the sort of assessment, Deepak, now? Markets near term from here?
It's interesting that you say near term, because I think we're all, kind of on agreement in the long term that things are going to be still better for India in comparison with the rest of the world, perhaps. But the near term, everybody's more scared right now. I think most people I meet are still scared that the markets are overheated, that this is not the right time to put money in the markets. But the markets themselves are showing something else. There's a behavior that says, well, we want to put in more money. So there's more money coming into mutual funds. There's more money coming into equity. Domestic flows are strong. I think while domestic flows are strong, the flows are going to dominate the discourse, right? So to a certain extent, earnings and numbers will kind of be secondary, but eventually they start playing a role. So your problem is your price to perfection in some stocks, but not so much in the others. There are lots of stocks which are trading at perhaps levels they were trading at 3 years ago. In fact, the biggest, HDFC Bank, for instance, where we might have a position. So I think that that is there's a dichotomy of stocks. There's a lot of smaller cap stocks which are more expensive in that context. But I do think there is a lot of cheap stocks available in the market, and there is definitely something that to be said about finding good opportunities here. I think until it comes to a point where everybody is jumping in this euphoria, and literally that euphoria is translating into 30,000 Nifty is here, going to be here soon and all that. I think that's the time when you'll probably see that the markets top out, if you may. And usually it's liquidity that takes it away. So it's either a big IPO or a big global event that takes away liquidity from India. That I think is going to be the cause, but it may not necessarily be valuations.
All right. Hi, Deepak. Good morning. First of all, congratulations on the big development for you as well as your team. And it's been great being in touch with you, Deepak. Even pre-Twitter days, when you call up and, reach out to you, you'll explain things extremely simply. So kudos to you, the team. And I believe market takes you to other aspects of a person as well, whether it's the dancing or driving down to the coastal part on the beaches. Well, I've looked up to you on that. So enjoy life and wish you well professionally as well. Let's focus on the markets then. And one stock I wanted to address, if you track it, is MediAssist. They've gone ahead and they've done some inorganic growth. They've picked up Paramount TPA. Valuation-wise, it seems attractive because they bought it at around 2.5 times, on a sales parameter. And MediAssist itself trades at more than 5 times. Any view on MediAssist or this theme?
No, I'm sorry, I haven't tracked it at all. So I have no context of the numbers. But in general, let me say that if it's the 2.5 times sales and they are valued at 5 times sales in the market, this is actually a boost rather than a bane to your list. But sorry, I don't have any more fundamental news to give on this topic.
Okay, all right, got that. Because 2.5 times sales is what they've done it at. They themselves traded around 5 times, and on a PE basis as well, MediAssist trades at more than 45 times, and this asset has come in at less than 40 times. So we'll keep that aside. Let's focus on a couple of themes. Yesterday, we had the metal index that came back. Now, data points coming out of China are still extremely weak, but the street is willing to look ahead, and balance sheets are in far better shape. Anything you like from this space, either ferrous or non-ferrous?
No, we're actually away from metals because I think the dynamic here is cyclical, and I don't think the cycle's meaningful enough for us to take opportunities. To be fair, I find more opportunities outside of the space in terms of growth. The cyclical story is not very, not really exciting right now. We don't even see a major special situation in metals, in any kind of metals right now. Though I think, inflation numbers all over the world will cool, and I think that will provide a cap to overall prices. So I think not very interested in the metal space right now.
Deepak, what about the refiners? There's so much going on right now. Crude has climbed back to about 81. And there's enough chatter about what happens. We're getting to state elections, whether there will be any price hikes at the pump level at all or not. But what's your overall sense? Do refiners, I mean IOC, BPCL, HPCL, do they merit a place in the portfolio?
Yes, definitely. I think there is actually quite a big demand for. I think the idea over here is not the refining piece, but the oil marketing piece. The oil marketing piece has legs in that sense, because you don't have that much of a demand change, but the supply characteristics are changing, and to a certain extent, I think oil marketing companies will benefit. I don't think the refining game is quite as much in terms of our interest going forward. I believe honestly that we have some positions in oil marketing companies, but not meaningfully in any other of the core refining companies. The idea over here is that if you look at the crude prices over the last 2 years, despite Ukraine, despite the wars everywhere else, we haven't seen a major spike in crude. So it would have otherwise gone to 140 or 150. And it was 140 in 2008 also when there was a crisis. So right now it flitters between 70 and 90. So I think the marketing companies will make money in the long term, make a lot of cash flow. And to be honest, they're not that expensive. There are few non-expensive pockets in the market right now. But overall, I think refining is not really the place to be. We own Reliance, but it's not because of the refining arm. It's mostly because of Jio and the retail arms.
Well, speaking of Reliance, because we are getting to the AGM, you led us to the next question, and you were saying you don't own it so much for the oil and gas or the O2C business, but for retail and telecom. What would be the watch points for you in the AGM this time around? I mean, aside of the big announcements about any sort of business reorganization or demerger, that aside, what else would you watch for?
That's a good question. Actually, their AGMs used to be a lot more about announcements, but the last few years, they haven't been quite as much in terms of big announcements that have come in. There have been good incremental announcements. So we'll have to wait and see. They might throw a surprise out of the hat, or it might just be like they're just going to be bigger and better in that context. They have, in the last few years, accumulated more debt than their cash. So earlier they used to have almost as much cash as their debt. So there is a debt increase. But to be fair, if Reliance doesn't increase its debt, then who else will? Whole industrial lending has been stagnant for 4 or 5 years now. But I believe, at this point, I'll only look for surprise announcements. I don't think there'll be much more coming in from there. Of course, they've also applied. I think they will also probably be getting an approval for a mutual fund. That would be Geo Financials. So looking forward to that as well. I think it'll overall, I don't expect much, and I hope we'll be surprised on the upside. But the bias is that we own the stock.
Right. Deepak, I just want to put out a tweet which kind of went viral yesterday. And this is on the SME space. I'm sure that you would have kind of seen this as well. It'll come up for our viewers. This is a gentleman called Akshay Jogani who put out this tweet. He said, the resourceful automobile SME IPO is crazy. 2 Yamaha dealership showrooms, 8 employees. They asked for 12 crores and they got about 3,000 crores, 2,700 crores in bids. Market cap at 31 crores at IPO price and a net worth of 1.5 crores. Is no one asking what the terminal value of 2 dealership showrooms and 8 employees is? Of course, I mean, the fact is that they could be raising this money to expand, open 10 new showrooms. We don't know. but we had to go into the details of that one. But I mean, I'm just using this as a I'm sure you must have seen this on social media, and I don't know if you had any thoughts. There are two parts to it. One, of course, is the approval itself. Now, the SME IPOs are not approved by SEBI; they're approved by the exchanges. That's one. And second, of course, is the demand. That's just, I mean, liquidity, right? I mean, what do? You ask for 10 crores, you get handed 100,000. I mean, you know, you can. Yeah, go on, Deepak.
Prashant, so to be fair, we're not handing them any money. It's all what's happens in the IPO space is you keep your money in your bank account and then you apply, and then maybe you get some, you don't get some, but the money never leaves your bank account, right? So you want to bid for as much as possible, whatever cash you have in your account, simply because that just increases your chances ever so slightly of getting some kind of allocation. And that is what's driving a lot of the IPO market. And that's what's driven a lot of the IPO market in the past. In fact, at that time, people used to take loans to keep money in their bank accounts so that they could bid for higher numbers. So you would get this 1,000 crore IPO getting 4 lakh crores worth of subscriptions. It's not 4 lakh crores. It's just like temporarily borrowed money from NBFCs until RBI put an end to it, and SEBI eventually also put an end to it, saying you can't do all this borrowing money, like 100 crores borrow for 2 days and then apply for an IPO and all that stuff. So now the numbers are smaller because the IPO is smaller. Secondly, I'd say the big thing here is this is what the SME is for, SME exchange is for. It's a small company. It's less than 25 crores in paid up equity or something like that. It is trying to grow. They need to raise money. Now, would you rather have them raise money through debt or go to some private financiers or venture capitalists or come to the markets? I think coming to the markets is actually the best thing to do if you want to raise equity, because you will have a layer of transparency on top. You will have to reveal your numbers. At least once in 6 months for the SME exchange, but you'll also be able to participate in growth. A lot of SME companies, some companies that we know of, say E2E, which listed in the SME exchange at, I think, 50 crores or 60 crores when it started. Today, it's valued at, say, 2,000 or odd crores or close to that in the market. So I think there are companies that start off as SMEs and then build up from there. Yes, we could make a meme out of this saying 2 cycle showrooms, only 8 employees. But honestly, it's not the number of employees. I think they make 1 crore of profit and, the value is 31 crores. So effectively, they're, just the cash returns on this 12 crores that they raise, if they just kept it in a bank account, that would double their profit pool or go give a significant boost to their profits. So the profile of the company changes, and of course, hopefully they will give a better return on equity. I have no comments on the company. I haven't analyzed this in meaningful detail. I'm not outraged about it. So I think
I was also not outraged, but I wanted to ask you if you were outraged, because it just seemed a lot of outrage all around. I mean, a lot of exclamation marks, etc. But I mean, it's not the terminal value of the 2 showrooms, right? I mean, they could expand whatever. And the idea is to boost SMEs. Of course, there are lots of winners and wealth creators in that space over the last couple of years. And like in any market, in any segment, there are also disasters. So one needs to exercise caution here and on the main board equally. Point taken. It's an interesting space, and we'll come back to this in a greater sort of way later, Deepak. But thank you very much for joining us this morning. Really appreciate your time, and once again, congratulations on the mutual fund license. We'll, I think, take a quick commercial break here. We'll come back with the management. Our first corporate of the day, Zen Technologies, will be with us in a bit.
Welcome back. You're with us on Bazaar Morning Call. Let's quickly get to that promised conversation with the management of Zen Technologies. The stock has seen a strong run this year. The returns are over 130% if you look at the last 12 months. And the company has now successfully raised 1,000 crore rupees via a QIP. To talk about the business outlook and the plans going forward, we have with us Mr. Ashok Atluri, Chairman and MD at Zen Technologies. So thanks very much for joining in. So let's start right there. 1,000 crores in the bag. The last time we were in conversation, you did indicate that you would be looking at potential acquisitions. So has something been firmed up? What are the timelines like? And what exactly is going to be the specific utilization of the 1,000 crores you've raised?
So we are still looking at, we are in talks with a couple of companies, and they're at quite advanced stage. And again, once we are able to sign the documents, then we will be able to reveal the names of the organizations that are companies that we are trying to acquire. And as for the utilization, we are looking at the inorganic, inorganic growth through acquisition. That's one, and the second is working capital, and finally some bit of capex and internal R&D that we want to do, and general business purposes. Yeah.
So, Mr. Atluri, on the acquisition, the first point that you said, give us some idea of the size of these target companies that you're looking at, and also the specific technologies or the areas, industrial areas in which they operate. Where would you be shoring up your presence? And again, out of 1,000 crores, I mean, are you setting aside, say, 500 crores for these acquisitions, more, less?
So it's a flexible. Currently we are saying about 350 to 400 crores, and the size of acquisition we are looking is between 100 to 250 crores. That is the acquisition size we are looking at. So that would accommodate for a couple of acquisitions for us. Yeah, and the area that you said, where are we focusing on? We are focusing on both the simulation market and the anti-drone or electronic warfare market. We're looking to strengthen ourselves in both the segments, and we expect that interesting companies are there in these spaces, and that will help us, fill some gaps that we have for our future strategy.
Mr. Atluri, so 100 to 250 crores is the size, and you will do at least two, right? You said a couple.
Yeah, 2 to 3. I mean, we are open to that. Yeah, that's right. 2
to 3.
Yeah.
So you're talking to at least 3 companies, and in advanced stages, then, right?
No, this will accommodate 2 to 3 acquisitions. Yeah, and we are talking to a couple of companies. You're right. Yeah.
Okay. And it's in both segments, simulation and anti-drone as well.
Yeah, that's right. Electronic warfare. That's right. Yeah.
I mean, if there is one industry which, I mean, you can look at what is happening around us. And I was thinking about it yesterday. I mean, when you read these headlines out of Russia, Ukraine, that drone attack, what you're seeing out there in the Middle East, right? I mean, it's just absolutely crazy. And the need for, I mean, what you make anti-drone systems, I think, you can see a real fundamental driver behind it over the next many years. I mean, just your thoughts. I just wanted your views, because this is all happening real time.
Yeah, so I think we have been lucky that very early 2018 we decided that we should focus on anti-drone systems, where the craze was drones. Everybody wanted to get into drones.
I think
we said yeah.
Go on, Mr. Atluri. I think we're losing you, but go on. We'll give it another shot.
Yes. Please go ahead, sir.
Yeah. So I think we were lucky that we invested very early on in 2018 into anti-drone space, and today, we have a lead over any other thing. Again, the Armenia-Azerbaijan war proved, Ukraine war is proving that drones are a different level. If you in a gunfight, if you bring the sword, you are going to lose. So all the other weapon systems are becoming absolutely, outdated. So the ADS is very, very big, and the anti-drone systems, and we can see as we speak the inquiries and the demand from not only India but all over the world. It is exploding at this point of view. No pun intended. And the second was.
Okay, all right, Mr. Atluri, I think that line is not supporting us, but appreciate you joining, and thanks a lot. We look forward to the inorganic growth. One point that I would like to address with you was your operating cash flows that are yet to pick up. Even in the last year, it was only around 20-30 crores odd. So I'll want to track that. Revenues, EBITDA, everything's improving, but the operating cash flow is something that I'd like to address, given that institutions have put in 1,000 crores for just 6% in the company. Maybe that discussion for another day. For the time being, slip into a short break. You come back, we'll have our technical experts, Mitesh and Sudarshan, will be joining in.
Welcome back. Just a minute to go, and then we start getting the pre-open rates. Like we've been saying, it's a bit of a cautious morning across Asia. With the GIFT Nifty, last time we checked, the implied open was almost 14 points lower. We'll have the pre-open rates come up any second now. Well, let's quickly get to our technical experts as well. We've got Sudarshan Sukhani as well as Mitesh Thakkar with us. Good morning, gentlemen. Good to have you on. Sudarshan, so what's the sense when we're just about 70 points away from the all-time high? Cues are not very supportive, at least as we start. If there's a dip, will you buy it?
Hi, good morning. Well, if there's a dip today, I would not buy. We've had a very decent run, and that 70 points that need to be overcome would be overcome either today or in the next few days. I don't think we will shy away from new highs, but not today. In the sense, today is not a good day to buy. The markets can be choppy. This doesn't mean that the markets are going down. It simply means that markets pause. After all, every day is not a relentless buying, day. So the view for today is avoid the Nifty and the Bank Nifty and focus on stocks. If you have a positional trade, stay with that positional trade, keep a stop at 24,900 and stick with it. For intraday traders, avoid.
Okay.
Yeah. All right, I got that. Gentlemen, morning. Appreciate both of you joining us. Mitesh, what about you? What would sort of your strategy be and your ideas?
Morning, Prashant. So I think, yesterday we had a gap up opening and we closed near the previous highs. And to me, gaps are important. So I think, I would be a buyer on declines. But as Sudarshan said, I think, depending upon what kind of decline we get today, I'll take the decision. I think this gap level of 24,850, 860 is very important for me, which is roughly about 150 points lower. So in case you get a 80, 90 point kind of a dip, then yes, but not a 20 point kind of a dip. I think that doesn't warrant a buying. Around 25,000, around 24,900, take a 60, 70 point kind of stop loss, take longs and expect this highs to be cleared, as Sudarshan also said. I think the view is that there's a strong chance of us making and registering new highs. And therefore, I think, buying on a slightly bigger declines is what I have in mind. But on stock side, we are clearly trading with more of long buys.
Okay, all right. Got that, gentlemen. Mitesh, tell us what about individual stocks?
I have 3 buy calls, Nigel. Hindalco made a fresh high, so very good chart pattern here should see some strong continuation on the upside. So keep a stop below 700, look for targets of 740. Dabur is something which I've recommended, very often in the last few weeks. Comes on the list again today. Keep a stop at 645, look for targets of 675. And a breakout happened in the charts of Bajaj Finance yesterday. Bajaj Finserv. If there's a pullback around 1680, 1675, which is about 8-9 point kind of a decline, buy with a stop at 1650 for targets of 1745. One sell call, Federal Bank, keep a stop at 201.5, look for targets of 190.
All right, got it. So Darshan, let's come to stocks. What will you work with today? What's the list?
See, the list is an all-buy list. It's so much easier to buy in a bull market. Ultratech Cement is a buying opportunity with a stop under 11,200. Divi's Lab is a buy. Pharma is on a roaring, uptrend anyway. Divi's Lab is a buying opportunity with a stop under 48.50. Techem has been outperforming the other IT stocks, and the other IT stocks are outperforming the Nifty. So Techem is a buy with a stop under 1600. And finally, an old favorite, Asian Paints, has come out of a 6-month long consolidation. That's a positional buy with a stop under 31.20.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's turn the spotlight on the IT sector. That was the one that was buzzing yesterday in 2024. In fact, the IT index has outperformed the Nifty. Jeffrey says that the recent move may lead to price-to-earnings re-rating. To help us out with a quick analysis, we're joined by Sandeep Agarwal, fund manager at Subilo Investment Managers. Hi, Sandeep. Good morning. Thanks a lot for joining in. What's your take? The Indian IT space has outperformed the Nifty. We're trading at valuations in excess of what is the norm, in comparison to the 5-year average, and also at a premium in comparison to what Accenture is trading at. Your view on the sector from here on, and what's the top pick?
So, hi, good morning, and thanks for having me in the show. So, Nigel, we have discussed this many times in the past, and I will reiterate that, this is a sector where large caps generally should see a revenue growth of 8-9% because industry grows at 3-4%, outsourcing grows at 6-7%, and we gain some market share every year because of benefits of scale, availability of manpower, and all that. So our large cap grow at 8-9% on average, and because of some improvement on the margins, the EPS growths are generally 11-12%, also partially aided by buyback of shares, which reduces the share count. Now, this is the actual mean average which the sector does because it is a matured sector. But when 1 or 2 years you don't see any growth coming in, or the growth is below this mean, then it all gets bundled up and shows up in the 3rd year or 2nd year, and the stock performance are little outsized. So I would say that this sector should be seen as a pure long-term investment sector where you should expect on an average, if you are putting your money for 5 years, 10 years, you should expect 12-13% on the large names, and the mid-size good quality names you should see 15-16%, and the small ideas, if they work out, you can see 20% CAGR on the performance. So that is the way this sector should be seen. So in Jan and Feb, there was extreme pessimism at that time. Also, our view was that, given the data of how attrition has come down sharply, the margin should surprise. And I'm telling you today also on the call, this quarter, you will see bumper margins by all the players. And every analyst will run to, upgrade the numbers, and the stocks will also move up. And then revenue growth will come after that. And once revenue growth starts coming in, you will again see attrition picking up and slowly margin is tapering up. But we have another 2 quarters where this stock should do well. That is what my sense is.
And your preference would be between the large, the mid and the small cap companies? What would it be? Because the growth is going to be better in the small cap names on a lower base. But, if you're allocating, say, $100, how would you split it up?
So, we run a PMS, so it is very hard to call out the names of the stocks. But let me put it this way, that within the large cap, the stocks which are trading at a much reasonable valuation and where there is turnaround stories likes of HCL Tech and Techem, they will still continue to surprise from here in my view. Similarly, in the good quality mid-cap names, if you leave aside the R&D names, ER&D names, because in ER&D, I still believe there is a small blip which can happen because of availability of manpower. It is still challenging in that area. Then you can get good opportunity to buy some of the names. But otherwise, the mid-cap IT services names are really overpriced in my view. Better to look at some of the names in the small space where the stocks have not moved up. And they also, the margins are at bottom. So, likes of FirstSource, likes of Gensar, likes of Buildersoft, these on some of the names like Onward and Axis Gates. These are the names where, there is a lot of scope for improvement of margin and growth momentum. So I would generally prefer a ER&D small cap or mid cap play where, there is some correction or if they are little reasonable, because see, ER&D any which ways for next decade will outperform IT services by at least 2x. So best to play ER&D at reasonable valuation. That is what I believe. And in the large cap, you play the names which are reasonably priced. So you have a play in large cap and you have a play in small cap. Mid cap, I think, is an overcrowded space now.
Okay, so ER&D, that's the place to be in. Got it. Just to go back to the earlier points in the morning, to go back to the earlier point when you said that if you're looking at a long-term exposure, then expect, I think you said 12 to 15% kind of return. And that's on a stock level basis, right? That's the overall return to expect steady state long-term from IT in your portfolio. That's the point you made, right?
Yes, absolutely. So what I'm trying to say is that, this industry is 8% revenue growth and 12% earnings growth. So you can expect 15-16% kind of stock return for the large names on a stable basis. So if it has not come for 2 years and the third year, it will come 30-40%. It has always been like that. If you see last 10 years, it has been like that only.
No, absolutely. So now the question is, what's the kind of multiple that you're willing to pay for that? It's not bad, right? Steady state. If you're saying the Nifty earnings compounding and overall compounding is supposed to be between 12 and 15%, and long-term IT will give you the same with reasonable margin of safety, cash, etc., etc. So maybe it's not that bad. But the question is, how much are you willing to pay for it? So multiples right now versus the peak, what's the further expansion that you think will still be digested by the market?
So I think 2 to 2.2 times PEG ratio is what anyone should assign. So I think for the large names, anywhere between 22 to 30 times is a reasonable multiple, because as you rightly said, there is a lot of cash balance, stability, and all that thing. And also remember one thing, that last 1.5 years, NASDAQ has finally made a new high now. And, most of the companies have done phenomenally well. And now the numbers will start tapering off. So the follow-on will be on Indian IT. We have not yet got the benefit of the growth which the ultimate market has seen. So always we see an impact with lag effect. So we will have honestly 3-4 very good quarters in that sense. So 2 quarters superb revenue growth and margins, and then followed by 2 more quarters of good revenue growth but mellowed down margins. So I think we have to yet get benefit of, and it always happens like that, we get benefit for next 3-4 quarters after this Apple and Google and everyone does well. So we have next 4 quarters which are good in my view.
Next 4 quarters could be good. Okay, we'll have a longer conversation later. But your point was 30 times earnings, price to earnings, is perhaps what would be fair, which is exactly where these stocks are. I mean, the sector as a whole, Nifty IT at 30 times. So let's see if there can be any further expansion. Thank you very much. Little short conversation today because we're running into market opening, but really appreciate your views.
Surbhi, I was thinking in IT services, a lot of action is in the unlisted space.
Yeah.
And I think Sandeep would very well know what's happening there because, the point is that the larger ones are so large that you're getting an exposure to a lot of stuff. But there are a lot of smaller companies, doing AI work, specialized work, which are all kind of making a beeline into, so this pre-IPO kind of investing is also...
I'll ask you about it later because I'm quite interested in that. If they're taking the small ticket.
No, I mean, and there are actually structures now, right? I mean, I think these pre-IPO, close to listing kind of structures, AIFs are booming, looking at getting in earlier rather, in that sense. Well, I think we've got the Nifty IT index on your screen, 34 points. But Sandeep made a good point. He said last 2 years we've not got returns. But over the next couple of years, you will get that CAGR 15, 16, 17% kind of return from IT companies, which is, will be fantastic in any normal market. Is that we've been in a very bullish phase for a while now. So those returns look meager. Okay, let's bring in our 9-10 calls with both Sudarshan and Mitesh. Sudarshan, what do you have?
Consider buying TechM with a stop under 1600.
TechM, 1600. Mitesh, what about you?
So buy on Hindalco for targets of 740.
All right, Hindalco, a target of 740. Gentlemen, thank you very much, both of you, for joining us with that. Let's sort of put the spotlight once again on a few of these stocks which should be in focus. MediAssist is something we want to talk about. Yash is here. Yash, it's a big deal and a good one.
Well, that's correct, Prashant. One of the largest deals as far as the insurance TP or the third-party administration market is concerned. We don't hear much about this. Only one company listed from that particular space, and that is MediAssist, which has decided to acquire a TPA company called Paramount TPA. The deal happens at an enterprise value of about 312 crore rupees, equity value which is estimated to be upwards of 400 crore rupees. Just to look at this particular deal for MediAssist, that is Paramount TPA versus the last two transactions which they had done, Raksha and Medvantage. Paramount TPA is 3 times the size of Raksha TPA and 7 times the size of Medvantage. So as you said, quite a large deal for MediAssist. Paramount TPA deal is done at 2.5 times sales versus Raksha TPA, which happened at 1.7 times sales, and Medvantage at 1 time sales. MediAssist itself trades at about 5.2 times sales and 47 times enterprise value. Now, importantly, what does Paramount TPA bring to MediAssist? One, it is the largest transaction as far as the TPA segment is concerned. Acquisition to take MediAssist market share in the group segment higher by about 6% to 36.6%, and in the health insurance segment by about 4% to about 23.6%. So well aligned with what the company wants to do in the group segment, and a good transaction there for MediAssist.
Okay, bang on. Thanks a lot for that. Yash, well, let's hop across to Vivek. There's a note that's come in on NLC. He's here to cover it. Vivek, take it away.
Well, good morning. After NLC India's Q1 performance slightly muted, the stock saw quite a bit of a significant coverage. At this point of time, Elara has taken the opportunity to go ahead and initiate coverage on the stock with a buy rating. They have a target price of close to 373 rupees a share, a little over 30% premium to the current market price. First up, talking about NLC India, they note that the company has presence across varied energy multiverses, including presence in lignite as well as coal mining, power generation, power trading, and also offers consultancy services for mining as well as the power sectors. Remember, NLC controls over 50% of the country's lignite reserves as the designated nodal agency for lignite mining in India. A consolidated generation capacity of close to 6 gigawatt, and the company has plans to ramp up its total capacity to almost 20 gigawatt by FY30. Remember, NLC India also is in the regulated business, so has a fixed return of equity of 14% on captive mining and 15.5% on power generation segment, similar to peers, in the power generation segment. So, talking about the regulated equity that the company enjoys, 9,500 crore, 5,900 crore out of that allocated to the power generation business and 3,600 crore to the mining business. So, what is Elara anticipating? They say that over FY24 to FY27, expect revenue CAGR of 15%, EBITDA CAGR of 20%, and PAT CAGR of almost 20%.
Okay, interesting. Thanks very much, Vivek, for that. The upside is 100 rupees from where the stock is right now. So let's see if the market takes note of it. But overall, Prashant, I mean, it's not bad, right? Given the cues, at least the pre-open is suggesting that we'll start flat, maybe with even a green tinge.
Yeah, no, absolutely. And that's the market, right? And you need just a little bit of green, just a tinge, as you said, to take us to, I mean, go back to the highs, the previous highs. 25,025 is what the Nifty is suggesting. But let's see. The opening bell comes up. We're at about 25.21, 25.15. This is absolutely flat as they come. The sensex, okay, now in the red, but barely so. The sensex at about 81,700. Again, it's absolutely flat, down about 10 points. We've got the bank Nifty, which is at about 51,140. Advanced decline on your screen, 3:1 in favor of advances. So yeah, I mean, the broader market right out of the gates is looking very solid. The Nifty, though, as you can see on the heat map, is more mixed. So you've got about 15, 16 names which are sort of down, so a few unchanged, and an equal number which are higher as well. So 15 or 20 points lower on the Nifty to begin the day, 24,993. Let's talk about individual names.
Absolutely. Well, on the Nifty, bringing up the red side, BPCL. In fact, let me look at the other oil marketing companies as well. Yeah, even on HPCL, IOC expectedly, there's about a 1% decline coming through over here. Weakness in Hindalco after yesterday's mega rally. We're seeing some weakness on Tata Steel as well. Some of the commodities basically losing ground. There's Shriram Finance, Asian Paints. These are the stocks on the way down. Paints perhaps seeing an impact of the higher oil price, the kind of rally that we've seen yesterday. But then on the flip side, you've got a Power Grid, Ultratech Cement, HCL Tech, which has extended its long-standing partnership with Xerox. That's rubbing off well on the stock. There is some buying on an ONGC, Britannia. Apollo Hospitals is reversing some of yesterday's declines. And L&T is up about 0.5%. The Bank Nifty is doing absolutely nothing, absolutely flat. HDFC Bank is on the flat line. ICICI Bank is hardly changed. Kotak is down about 0.5%. Axis is down about, hardly down, just absolutely flat. And SBI is also at the flat line. So the banks are very, very quiet at this point in time. And we have an even-Steven market, actually. Not 1 point up, not 1 point down.
Well, the stock definitely that's in focus is NIT. What a beautiful move, right? Mr. Damani has checked in, and from there the stock is up closer around 45-50%, in a matter of a few sessions. Yesterday it was high, the previous sessions as well it was locked, and today it's up closer around 10%. Let's see whether or not, it does cool off a little bit from here. So that's the stock at around 170 rupees. GSPL, the street clearly believes something's got to give out here, so they're sniffing some kind of action out here. For the time being, the stock is up close to 6%, putting on weight after yesterday's big move. Aarti Drugs, they announced a buyback, very, very small buyback, but the street likes it for now. The stock is up another 3%. Edelweiss Financial, one of the top volume movers today, that stock as well is holding with good gains in today's trading session. High-Tech Pipes, that's another one that's doing rather well in trade today. Remember, they are coming to the market to raise some money via the QIP route. They joined us here on CNBC-TV18 and they guided for better times going ahead. So that's a stock that's in focus as well. It's a good start.
MediAssist, I forgot to mention that. MediAssist is, market likes this acquisition and the pricing perhaps 10% up.
Well, and the writing was on the wall, right? When you're buying an asset that's trading at around 2.5 times price to sales and you are trading at around 5 times price to sales, well, the street will like it. And also on a PE basis, MediAssist trades at more than 45 times, while you have the acquired asset that's trading at less than 40 times. So valuation-wise, that asset is fitting in, it increases their market share, and that's the stock of the morning, up 9%. Prashant.
Well, let's look at a few other names before we welcome in our market master today. So 1,300 stocks are higher, and you've got about 700 odd stocks which are lower right now. So actually, it's about 2:1 now, moderated a bit on the downside. Just a few specific names. So, and by the way, keep an eye out on the Nifty, right? And the distance to the previous high. We'll put out a sort of clock in that sense as well and see where we are at. So GSPL is the biggest volume-led gainer. So that's Gujarat State Petronet. That's 6% higher, and GSPL has got humongous volumes, 3.5 million shares on it at this point in time. Oil India is again got humongous volumes. It's up 3%. So with the slight relief in oil prices from 77, we are back above 81. Oil producer like Oil India seeing some relief. Aarti Drugs is up about 3%, 625 right now. GMR Power 2.25%, 129. It was a mover yesterday, at least at start as well. NLC India, we mentioned. A name like Balu Forge, I mean, out of the blue, it's a name we've sort of put out on our chatter list over the last 6-8 months with Nimesh. 5% higher, 800 rupees, and stocks, it's got volumes, and that's why I'm highlighting it. Never ever figures, with volumes at this point in the day. K Fintech is up about 5%. K Fintech is at about 1,060 or so. Shilpa Medicare is coming up with a 3% gain. Stocks at about 755. Shilpa Medicare, of course, has also had a very nice move through the course of this year. Tata Tech is the biggest volume-led loser. Tata Tech is down about 1.6%, and that's at about 1,032. There is CDSL, BPCL, Policy Bazaar, RPSG Ventures, the Sanjeev Goenka Group holding company is down 4%, but it's had a spectacular rally. And Reliance Power is down about 5% as well. It was down 5 yesterday. It's down 5 again this morning as well. So that's essentially the overall picture. We are holding about 25,000, 25,022, and we're up about 12 odd points or so. Rana Gupta is with us. He's Senior Portfolio Manager and India Equity Specialist at Manulife Investment Management. Rana, great to have you with us here on the program. Good morning. Prashant here. Do you sense, amongst institutional investors, what's the mood like? Do you sense a lot of enthusiasm that there is, there are greater upsides that you can see, or is there more caution and more wonder at this stage, Rana? What are you seeing?
Well, if you're talking about the foreign investors as an institution, then in looking at the flows, I would say that much of them have been quite concerned on the valuation. But having said that, I think the domestic institutions continue to pour in money. I think as per our understanding, the domestic flows are running at about $100 billion per annum, with the supplies of equities much less. So put together, if you ask us, we think from a from a liquidity standpoint, from a fundamental standpoint, the market is on good wicket.
Okay, Rana, hi. Good to have you on the show. The market's on a good wicket, you say. So valuations not much of a concern. I mean, where do you see pockets of opportunity in the market?
Sure, I think the valuation overall market, I think if you look at some of like the industrial stocks there, I think the valuations is an issue because they have a fantastic run over last 1-2 years or so. But we do see pockets of opportunity. For example, I think let's look at the domestic consumption, a sector which has not done much. But within that, we see opportunity in sectors like telecom. We see opportunity in sectors like two-wheelers, tractors. Also, we see opportunity in real estate ancillary kind of industries. With the specter of rates coming down and hopefully liquidity improving, we also see opportunities in banks, large banks which suffered due to liquidity in the past. We also see opportunity in the smaller banks or the non-banks with a fixed asset book. We see opportunity there. Also, given the wealth creation in India, we continue to see opportunity in the wealth and asset management businesses.
Okay, all right. Hi, Rana. Good morning and good to see you. Tell us about this real estate ancillaries. What are the plays you're looking at? The tiles players? Is it the pipes players? Give us some clarity on that front. Which is the segment you're looking at?
So we are looking at the segments like the pipes, the cables, the switch gears, the lighting and all those segments. Because all those segments, we believe the organized sector has a definite edge and they can do better. The other sectors are good. I think overall volume growth will come back, but there is just too much of competition. And we would rather want a bit of less competition, a bit of more volume growth and pricing for the businesses that we like.
No, absolutely. And a point taken. Rana, any thoughts on real estate? The cycle continues, sales, etc. are strong, but at the margin, one is starting to hear more and more anecdotal stories, right? But it's a consumer sector, so anecdotes is an important part of the mix. There are a lot of speculative activity as well, and I think institutional brokers are also starting to talk about it, at least formally. I think there was a Kotak recently wrote a note about it. What's your sense? I mean, is it a bit of a concern, or things are looking rock solid? And that's a sector which is not just important for that space itself, but it supports so much else.
Oh, absolutely. Real estate is a very important sector that way, as we are all aware that the domestic capital formation is largely around real estate sector. Plays a very important role in that. Now, to your point on speculation, wherever the prices goes up with volumes and in such a large sector, there is bound to be some speculative activity. But that does not mean that the sector does not have potential. In the sector, there's a lot of potential. Within the sector, we like residential as well as commercial property. What we like are the companies which has large land banks, and therefore they are not under pressure to sell, and they can we can choose their launching time and which pocket they want to launch. Of course, there is a theory in the market that the real estate companies should not hold land and launch as fast as they can. But given the speculative activity that comes with it, and given the price ups and downs come with it, we would like our companies to kind of have that a strong balance sheet and land, so holding power to launch whenever they would feel it gets the optimum, the optimum from that land.
Okay. Rana, what's your stance on IT, both large cap and mid cap? We were just discussing this with the guest earlier as well, because now in general, sector valuations at about 30 times perhaps are reaching, some would say, optimal levels. But would you be willing to add more? And with what lens are you looking at IT?
Look, I think in IT one has to be somewhat bottom up, because the large companies in IT, they're basically, one is expecting the bottom line growth of 10-11%, and they're trading at 25, 26 to 30 times. So they can give you compounding, but I'm not sure 10% compounding is something that the investors all will be happy with. But bottom up, we see opportunities. Bottom up, for example, let's think about in the US, if the rate cuts were to come back, if the housing sales were to do good, there are IT companies bottom up that you can find which are a lot of exposure to that area, and because of that, they suffered in last 1-2 years. So they can make a big comeback. So like that, you can find out bottom up IT companies who have suffered in the last 2 or 3 years because of exposure to mortgages and those areas, and they can make a big time comeback.
Rana, what about these new age themes? Many of them, people were throwing in the towel and suddenly they have become the flavor. Everyone wants to, look at them. Zomato at these prices, it was less than a fourth of what it is currently. But now everyone's talking about the big opportunity. Similarly, even Paytm, it's been a rank underperformer, but from the lows, it's up more than 60%. Anything you like in this space? You can maybe throw in an Ola Electric as well in there.
Look, I think, we like this space. I mean, to begin with, we wrote a note about a year back from now, where we highlighted the digitization theme, and our subline for the theme is let the cash flow. What we understood at that point in time is that many of these companies, they have put in all the required investments, and thus they do not require a very strong top line growth for the operating leverage and cash flows to play out. And frankly, that's exactly what happened for most cases. And we are happy to see that play out. So the key for us is, if a company builds a platform, how can they add services on top of that platform without making further capital investment? So therefore, the incremental return should be quite high, and that compensates for all the investments that they have made before. So we like companies in the, let's say, in the food services, in the quick commerce area. We like, those kind of platforms.
I mean, and it's incredible, right? I mean, if you run around the world, these companies have not done well, most of these companies. But here in India, it's been a different story, especially things like Blinkit, etc. Now, of course, there is Zepto, which is also garnering a lot of attention. By the way, have you met the folks at Zepto, Rana?
Not yet.
That's a hottest new thing. I mean, we had, I think, the Motilal, the conference, and Motilal representatives telling us that, the most sought after session was the session with Zepto. It kind of sort of talks about what's happening in that space and the excitement around that one. It's something we'll watch. I just want to take a quick look at the market as well. It's kind of like it's nothing, 5 points lower, 10 points up. So just middling around with no real directional move at all at this point. Cosmo First is down about 3.5% odd percent, 845. Panacea Biotech, which has had such a one-way move over the last 1 month or so, is down about 2.5%. So these are simply just pullbacks and profit booking that we're seeing. Policy Bazaar is another one which is down about 1.5 odd percent. And I think I mentioned CDSL, which is down about 2.5 odd percent as well at this point in time. One new addition on the upside is Castrol, if you want to look at it. 275 on Castrol now. And, there's been a constant bid for the Castrol whenever it's come off. The range on this one over the last 1.5 months has been about 230, 235 on the downside, and it's gone up to about where we are now, which is about 280-ish levels on Castrol. Ola Electric is the other one, which I think is making a bit of a comeback. So the low yesterday was about 118, and the high, the all-time high, of course, after listing was about 157, 118, and is back at about 131 right now. So a large amount of volume traded on Ola Electric as well.
Just one more stock, Gillette, which we highlighted earlier today, Prashant and Surbi. In 2019, the stock was close to 8,000 rupees, and then everything went wrong, for them. So the stock currently is making a fresh 52-week high. The shaving trend has returned. In the middle, no one was shaving. The appliances segment has been firing for them as well. And the products that they have launched for women as well are improving. So that's why, there seems to be some kind of optimism out there. It was an 8,000 rupees stock in 2019. So if you look at that, then it's only at 9,000 rupees after nearly around 5 years. But in the recent past, in the last 1 year, the stock has doubled actually. So that's why it explains some kind of optimism coming in there.
Nigel, about 20 years ago, Warren Buffett was asked about Gillette. And his response was in his quirky humor. He said, men have one face, women have two legs. So that is Gillette for you. And it's just, it's a big, sort of over a period of time, over a long period of time, of course, it's a sort of a big wealth creator. I think used to be about 700, 800 rupees back in 2006 at about 9,000 rupees, 9,100 rupees at this point in time. But yeah, some of these businesses are looking good. Rana, just one quick point. So let's talk about what is ahead of us, right? Elections are, I think, going to be important. Some are saying, well, general elections hardly caused a speed bump. So why should state elections really matter? Maharashtra is an important state. I've seen some institutional brokers talk about how it's going to be a big one. It's going to either solidify the impression post the general elections or it can reverse it. Will it have a market impact one way or the other? Rana, what's your sense?
Sure. I think the state elections, that way there are not just Maharashtra and Delhi, there are many state elections in the next 2 to 3 years. For us, the significant one was the central election. Of course, not to say that state elections cannot impact the market on a day or a week or even a month basis. It certainly can, depending on the outcome. But since even before the election and after the election, our view has been that the government, in terms of their spending, they had done a lot on the industrial, manufacturing, and the corporate incentive side between 21 to 24. And that now going forward, the incremental spending, while the spend will continue, but the incremental spending will happen on the job creation, on the consumption, to boost consumption, or the welfare side. I think that view absolutely remains, irrespective of the election outcome. I think that is something that we are, quite, confident about. And this kind of ties into what I said in the beginning of this call, that we like that, the telecom and the consumer segments.
By the way, I just want to go back to NIIT. The stock is up again another 12%. We've been highlighting this. And something that is worth noting is that not only did Mr. Ramesh Damani sort of step into the company, check into the company with that 0.5% equity, promoters have infused money. They've increased their shareholding as well. The increase in the promoter shareholding is a little over 2%, 2.6% to be quite precise. And that seems to be bolstering a lot of confidence as well. The company is anyway guiding for, I think, 10% growth in the coming quarter as well. So the business has been looking fairly sound and solid. And then you have Mr. Damani putting in money, promoters putting in more money, and the market's absolutely loving the sight of that. The stock's done, look at 52% in just 14 days. Let's pull up a one-year chart. It'll give us a an idea about the kind of surge that we've seen because of these recent actions. That's NIIT.
The other one is you talk about the money putting money. Look, the other one is Protean, right?
Yeah.
Protean, again, a company that he invested in. Stock, I think, I'm not sure, we'll have to confirm, but I think about 1100 or so was where he came in. Stocks now almost doubled to about 2050. But with Protean, it's essentially, and this is the thing with the market, with this wall of money which is coming in. The buzz around Protean is ONDC and, all the, of course, the budget also had some stuff in terms of mapping land holdings and how perhaps Protean could come in and a few other things as well. So a fair bit of excitement around all of this. But in terms of actual earnings, I think the company has seen earnings downgrades pretty much every quarter. You look at the last quarter results as well. I think, there were sharp earnings downgrades post the result. Profits themselves were down. And I think on a last 4-quarter CAGR basis, you're down about 20%, as far as Protean is concerned. But a lot of this some of these are, of course, futuristic business, and the bet is not every quarter or 2 quarters down the line, and you perhaps have to have a longer time horizon. But I think what is undisputable is the fact that markets are willing to have that longer term time frame or that view. Rana, I don't know if you have a view on some of these businesses or if you own any of them.
Well, I'll just say that on a top-down basis, whether it's the companies that you were showcasing. So these companies are they are creating new markets and or transferring market share. For example, this ONDC did not exist a few years back. Neither there were any institutional market in quick commerce, and a few years back there was no institutional market in even food delivery, or for that matter, online insurance broking. So these companies, through their capital or through their technology or through their position, what they have done, they have consolidated the market. They have become a platform for someone's the companies who started investing 3 or 4 years back. They're already a platform, so they are getting the cash flows. So I have no doubt in my mind, seeing those examples, many people would want to repeat that. Some of them will be successful, some of them will be not. For that, a bottom-up analysis of each company is to be done.
All right, Rana, we'll leave it there. Great conversation, and thank you for staying on a little longer than usual and sharing your views. So 24,986 is where we are at on the Nifty. We're down about 25 points, and market breadth is now much closer. The difference between the number of stocks up and the number of stocks down, 1350 stocks are up and about 950 stocks are lower at this point. Well, we want to play out some more sound bites, and this is from the exclusive interview with Rajiv Bajaj, CEO of the two-wheeler company, Bajaj Auto, and his goal of surpassing 100,000 clean energy vehicle sales. Mr. Bajaj also shared insights on the progress of the latest launch, the Chetak. Listen in.
As we head into the festive season, in the months of September, October, November, we are very likely to cross a monthly sales production and sales rate of over 100,000 clean energy two-wheelers and three-wheelers. But I would hazard that definitely over 25% of our current revenue is already coming from or about to come from clean energy vehicles, which is quite remarkable. See that Chetak is now close to about 18% market share, or just above 18% market share. We are neck to neck with our able competitor TVS and their iQube. I think just a few hundred vehicles separate us. Having just launched a third product, there are more due later this year, within this financial year. We talked about it the last time we met a couple of months back. And I think post the festive season and before March, certainly there will be more Chetaks in the marketplace. And I could reiterate what I shared with you the last time, that not only will there be more Chetaks in the market of the current platform, hopefully very sharply positioned, but there will also be a new Chetak platform.
All right, let's focus on CSB Bank. Quarter one was weak for the company. The highest decline we saw in the net interest income, and asset quality also deteriorated. However, the slippages declined in quarter one. How is quarter two shaping up? What's the outlook for the remainder of the year? We have Mr. Mondal, the MD and CEO of CSB Bank, who joins us on the show. Hi, Mr. Mondal. Good morning, and thanks a lot for joining in. Well, let's get a couple of aspects out of the way. What is the growth you're penciling in for the year? And tell us what went wrong in the last quarter the retail loan segment, I see there's a decline of close to around 12%. Why is that?
Good morning, Nigel, and good morning to all your viewers. Yes, we had a slightly soft quarter last year, last quarter. But going ahead, I think this year we are on track in terms of what we wanted to achieve for the whole year. Last quarter, we had two challenges. One is we had some regulatory kind of reasons for some NIM compression last quarter because of the because of the some of the income we are having on the interest side, that came down because of some regulatory reasons, penal interest as they call it. So that we didn't convert into penal income at this point of time. That will do from next quarter onwards. But this last quarter was to that extent a little soft. The other reason was that we are correcting some of our wholesale portfolio because our new team has joined. And that is where we are exiting some of the older relationships, not because they were any bad or anything like that, but because of the segments which we are going to focus on with the new wholesale team will be different to what we had been doing in past. So given that perspective, we are reorienting our strategy on the wholesale side. That's why we had a little bit of a softer growth on the wholesale. Also, some of our DA book, which was
okay, all right.
Well, on retail as well as on the wholesale side. So that's the reason we had a little bit of a soft quarter.
Okay, all right. So there were some, various factors at play. That's why quarter one was soft. Mr. Mondal, for the remainder of this year, what kind of a growth are we looking at? Point number one. And also margins did see some kind of compression in the quarter one for the reasons that you just mentioned. From here on, what is the range? I think in the past you've hinted at a number of around 4.5% to 5%. What should it look like?
So, Nigel, we have hinted around 4.5% to 4.8% in past on our NIM. We are on track to achieve that for the full year. Last quarter, it went below 4.5% for the reason which I told. On the growth, we do have ambitious plans. So we will be faster than the system by at least 30%. And that, what we have said, will continue. So we will see a growth somewhere between 18% to 20% on the asset side going ahead for the full year. And this quarter itself will turn it around in most of the ratios and parameters, because what we had in quarter one was really a one-off because of some specific issues, which has been corrected now.
Mr. Mondal, hi, morning. So let's talk about gold a little bit, right? Gold prices are up and up. If you believe some targets, it's headed to $3,000, higher, according to a few. What can it do? I mean, if we are going to see a bit of a structural kind of move higher, quarter after quarter, what can it do for your gold lending business? Certainly good news.
Yes, I think the international gold prices are higher for obvious reasons because of the overall Fed commentary and other reasons. However, there had been tax reasons that rates came down in India because of the recent budget announcements. But that has been offset by the international gold prices. So to that extent, overall, I think it is at the similar kind of a level where it was prior to the budget announcements. So given that, I think in India, it has not made too much of a difference, and hence our LTV and everything has remained the similar kind of a levels where we were before. Going ahead, as we see Fed interest rates coming down and things like that, we see bullishness on the gold loan business as well as gold prices. And we are fairly bullish that we'll continue to do well on that business. It's good news for everybody, for consumers, as well as for the banks at this point of time.
What's the sensitivity to your business? I mean, is there a sensitivity? I mean, can you numerically for gold prices and what it does to your sort of lending?
See, gold prices, you know that generally the LTV is around 75% as per regulatory norms as well. So to that extent, the risk related, we always have a 25% buffer plus the making charges and some other emotional quotient which is there with the ornaments. So given that, I think a 10% drop won't make any difference to anybody at this point of time from a risk perspective. However, as it goes up, we are of course cautious because we know that what goes up can come down as well. So we manage our LTV accordingly. And these are short tenor businesses. So in a short tenor, you don't expect because each of the tenor of these loans are anywhere between 6 months to 1 year. You do not expect too much of volatility in the prices at this point of time. So to that extent, we have been running this business for so long with sensitivity analysis, so we know how to run this business. So we don't see too much of an issue. But it's a good thing for us right now at this point of time because gold prices are going up, and hence we can look at expanding our business further.
Okay, got it, Mr. Monal. I guess just going back to the point on margin. So you're saying, I think what you're referring to is the change in regulations with respect to penal interest. And, you know, when the RBI was batting for borrowers saying that whatever is the penalty, it cannot be sort of counted as part of the interest and as part of the loan. But you're saying that's been rectified. So you're back on track to deliver 4.5% margin for the full year. Let's talk about asset quality as well, because in the first quarter, there's been some deterioration. We'll just get the numbers up on the screen as well. Your gross NPA is now moving up to almost 1.7%. So that's one concern. We'll have the GNPA numbers in just a bit. Yeah. So that's one concern. The other concern, sir, is going to be on deposit mobilization and CASA, because your CASA ratio is falling very rapidly. Now it's below 25%. It used to be around 30% a year ago. It used to be, I think, 27% just a quarter ago. So let's start with asset quality and then tell us what you're doing with respect to CASA.
Sure. So as you can see that our slippages have already started getting under control. And as we look forward, without making a forward-looking kind of announcement, our slippages are looking under control at this point of time. And we hope that will remain for the whole year. So we had one-off kind of a thing for the last 1 or 2 quarters, and that has been corrected. So to that extent, we don't see further increase in slippages at all. If at all, it will start coming down now. And to that extent, there will be lesser or no impact on the GNPA and NNPA side. And we expect it to marginally come down as well from the current levels in the full year basis. Coming to the deposit, I think, and CASA, I think that's a systemic issue. There are structural reasons why deposit accretion and ability to utilize the deposit to our asset growth has a challenge, because there are so many parameters we have to look at: CD ratio, LCR, so many other things. And to that extent, I think CASA ratio is another important thing, and NSFR, all these things are important. But from a CASA franchise, I think overall systemic, there has been a compression of 4 to 5%. Our situation is also similar. We originally had a lower CASA ratio. So that is, we are following the systemic compression at this point of time. But
just give us a number, sir, if you can. Sir, I'm a little sorry, apologies over there, just because we're running short on time. If you could guide for some sort of a range or a number, CASA by end of the year, and a GNPA level that you're comfortable with, where you want to be by 31st March.
Yeah, I'll say that. But quickly, the more important thing on deposit franchise is LCR and CD ratio, on which both we are very, very comfortable. LCR is 117, 118%, and CD ratio is between 82 to 85%. We are one of the better placed private banks in the system. Coming to the specific question on GNPA and NPA, we will be better than currently what it is, and hopefully will be somewhere between 1.5 to 1.6 on the GNPA side. And NNPA will be somewhere around close to maybe lesser than 50 basis points. So that's the way we are targeting for the full year basis. Quarter to quarter, we'll see how it plans out. On the CASA, I think we'll be somewhere below 25% at this point of time. But as I said, that we are not focusing so much of CASA because we are building our CASA franchise. We are looking at other parameters on deposit and funding franchise, where we are probably better than many other private sector banks in the system.
All right, Mr. Mondal, thank you very much for joining us. It's a pleasure. Appreciate you sort of coming on and talking to us and sharing what you make of things. I just want to highlight 2 specific names. If you can highlight, you can put up Religare, the stock. It's down 1.5%. And I think our colleague Vivek highlighted some of this yesterday. The high recently was about 280. From 280, it's down to about 260 now. That is Religare in 2 or 3 days. And of course, the immediate trigger really has been the management postponing the AGM to December. Investors have not liked it. That is one. And the second is Orient Cements. Orient Cements had a big fall yesterday. So, from the previous close of 330, it left off at about 310 yesterday, and it's down to about 305. That's a sharp cut. Here there was, of course, speculation that it's in the play as an asset which is going to be sold. There was the name of JSW which was doing the rounds as well, JSW Cements. So we'll have to see if something is, is it kind of gone cold or something is happening, but there was a marked move in Orient Cements and not other cement stocks. So perhaps something to do with the company and, of course, what the hopes and expectations they were. Markets down, of course, 18 points right now, 24, just under 25,000 right now. Nigel.
Okay, all right. Let's move on then. Let's get our next management on the show. We have Vinati Organics now. The company has given a revenue guidance of around 20% CAGR for the next few years. Brokerage, they have a mixed view on the stock. Motilal Oswal is positive. Kotak Institutional is a little bearish on the stock. To discuss the business momentum, the growth outlook, we're joined by Vinati Saraf Mutreja, the managing director of the company. Hi, Vinati. Good morning, and thanks a lot for joining in. Well, tell us, how's the year shaping up? Earlier, you were holding on to that guidance of around 20% growth, I think with margins of around 26 to 27%. Let's get both these two basic numbers out, and then we can focus on the business outlook as well.
Well, good morning. And these two basic numbers remain quite the same. We are seeing good growth in demand for most of our products, especially ATBS, especially compared to last year. IDB remains stable. We have gained market share in butyl phenols. Antioxidants is also picking up. And we are increasing revenue from that segment as well as the new products are shaping out well. So given all of that, we do expect a 20% growth this year, and I would expect EBITDA margins to be in the range of 26-27%.
Got it. All right, Vinati, I'm looking at a Kotak note, and they are talking about the ATBS segment. They're saying a new competitor, a smaller player, Atlantic Fine Chem. They have come in there and they have garnered close to 3 to 5% of the market share. Some believe that it could be a potential risk where you have a small player coming and creeping in there. What's your comment on it?
Well, Atlantic started production about a year back. From what I see in the market, they're still very, very small. And having said that, the demand for ATBS is very good. My new line for ATBS is coming up by the second half of this year because I have that sort of order book and my customers do want more material. So I really don't see that as much of a threat or really eating into our revenue.
If you could just expand on that. So let's complete the point on ATBS. Let's talk potential from this new capacity. I mean, first year, how much will it be working at capacity utilization? When it hits peak levels, then what's the revenue and volume implication? So ATBS, volumes and revenue projections for this year, and then once you hit peak with the new capacity.
Well, ATBS contributes to about 40-45% of our overall revenue. Now, what has happened is that the demand for the higher grade, the higher purity ATBS is very good, which actually limits our production. And hence the urgency to start the new line, the new production line. We do expect that the new production line has a total capacity of 15 to 20,000 metric tons, depending again on which grade we are producing. We do expect to reach that at full utilization in the next 2 to 3 years.
And then what will be the revenue implication? Also, just give us a sense, again, in terms of, the volumes that you look to do this year, the volume growth on ATBS, how prices are expected to shape up. And then also that number, when you hit the peak production, which is 2-3 years down the line, then, what's the volume then versus now?
Well, see, we are also adding new products. A lot of our volume growth is going to come from antioxidants, from butyl phenols, from Viral Organics, which is a subsidiary where we are making specialty chemicals such as MEHU, glycol. So they will also add to revenue. So the revenue share for ATBS will remain below 50%. And that is really the idea, to be not heavily dependent on any one particular product.
Got it. So, Vinati, then you mentioned 3 products, I think. So, 3 product lines that you're bullish on. Antioxidants. For this year, what does it contribute? FY25, how do you see it panning out? Viral Organics, I think you mentioned that was the second one, and butyl phenol. So, a rough revenue range of all these 3.
Yeah, correct. So, as of now, butyl phenols and antioxidants together is about 20%, maybe 18%. Again, going forward, this antioxidants will increase. Butyl phenols are probably running at capacity, and some of it will be used in captive production of antioxidants. So this number will go up to say about 30%. Viral Organics, we have just started. We are right now in the trial phase where our product is getting sampled, tested. We are also still optimizing the plant yield. So that will take some time to add to our revenue, maybe in the next 6 to 9 months.
Okay, so let's talk about the big numbers then, Vinati. The guidance that you've sort of, I think, spelled out is about 20% top line growth for this year. This margin, 26 to 27%. Any other lever that you see to perhaps push the margin higher, or will you stick to this range?
No, we definitely stick to this because, see, we do have about, we have formula-based pricing, contractual pricing, where our final product price is dependent on the raw material pricing. I don't see the margins fluctuating. Given our product mix now and going forward, this is a good number if we can maintain this over the long run.
Okay. All right, Vinati, we will leave it on that note then. Thank you very much for joining in. We'll take a break and come back on the other side. We'll be putting the spotlight on the Unified Pension Scheme. All the details and a discussion coming up with Indranil Sengupta, Professor of Practice, Shiv Nadar University, and Senior Journalist Sanjeev Srivastava.
Okay, welcome back. You got the market, which is up 25 points, and we're about 40 points away from the prior all-time high. Look at the bump, which is materialized out of nowhere, about 26 points in the green. Now, over the weekend, the centre has unveiled the new Unified Pension Scheme, the UPS, for government employees. That basically is a marked departure from the NPS scheme, which is the new pension scheme. And also different from the old pension scheme, which was, of course, prevalent for government employees who joined before 2004. Many, of course, have called it, something which the government is doing with an eye on the elections, which, many of these states which are going to polls have been demanding a restoration of the old pension scheme. And more. Some are still, unions, etc. For example, states like Haryana are still saying that this is not enough. We need, nothing will do but a restoration of the old pension scheme. But let's talk about this a little bit with Indranil Sengupta. He's Professor of Practice at Shiv Nadar University. He's, of course, also a sort of a veteran analyst from financial markets. Indranil, great to have you with us here on the program. Sanjeev Srivastava is Senior Journalist. Sanjeev, great to have you back on the program. Thank you very much. Indranil, so how should we look at this UPS? The government is saying, well, it's a balance between NPS and OPS. In terms of actual sort of fiscal implications, from what the government itself has shared, it's not very much, right? Because there is the contributory element which is there under this UPS, which was not there under OPS. Although the government is picking up the tab a little bit more. So your first thoughts, Indranil?
So I think that, first of all, thank you for having me. I would say that if you look at the OPS, that let us index at 100. The NPS was somewhere around 20. The UPS is going to be somewhere around 80. So in the OPS, obviously it was a defined benefit concept. In the NPS, it was a defined contribution. But then obviously, given that government salaries are what they are, that fell dramatically from the OPS levels. In the current UPS, it's closer to the OPS, I will say. But of course, you are still making some contribution. So that's one. Right. The second is that I don't worry about the fisc too much because this has been going on. It's all, currently the government is, has a fiscal outgo pretty much on the OPS levels. And for the NPS to have worked at all, given that the first, most likely people who joined at 2004 were at least born 1980, they would retire in 2040. And then for that to become a significant cohort would have been 2050, 2060. At the same time, there is going to be a substantial wealth effect, and that should actually lead to more demand for, maybe autos, maybe housing, and that should also be a boost to the economy.
And we should put that out. What you're saying is the net present value under, if NPS was 20, under the new UPS is 80. It's not quite 100 like it was under OPS, but it goes up to 80, close to the old pension scheme, right? So it's substantially more for employees under the UPS. Got it. I'm going to come back to you on that wealth effect point because that's interesting. Sanjeev, your first thoughts on what has been done and whether this is now going to be broadly acceptable.
See, so whether it will be broadly acceptable or not, Prashant, is depending on how much the unions can press for more. Because clearly an indication is coming from the government that they are willing to be, or they are vulnerable or susceptible to being pressed for more. So this entire exercise is another step on another link in that trying to process the election outcome of 2024, wherein the BJP missed out on majority. So I wouldn't say that this is a rollback, but or some kind of scaling down in a big way, but it is what the government is trying to learn from the election outcome as to why they lost out. So one reason they have attributed to, and I don't fully agree to that, they lost out because of the OPS not being there, but this trying to please different constituencies, keeping that on the radar, this step is being taken. So somebody like you or Indraneel will be better able to crunch the numbers, whether it's 80 on the old pension scheme and new pension scheme scale or 70 or 85. But what it signals is that the government, they're both positive and negatives to it. Negative is that they have become vulnerable, whether it's the Waqf thing being referred to the parliamentary committee going or other things. And this is another link in that direction. But the positive is that they are very good to adapt. So they're trying to learn from what real or perceived mistakes they made. So these are constituencies they want to address and get them back on board before the next election. I think it will be too late for a Maharashtra or Haryana kind of an election, but the big elections coming up, including the next big election, general election. So, but what is clear is that the government is vulnerable to listening, which was less of a listening government few months back. So that is both good and bad of how much a wealth effect is created, what really is...
Sanjeev, points taken and good points there. By the way, the elections are still not that far away there. We don't know. But what's your number for Maharashtra?
Mine?
You always have... Yeah.
You always put me on a spot. Well, I think Maharashtra, I don't have a number, but I think... the BJP and its allies, which is the present government, they are all on the back foot. So as things stand, they should lose.
Okay, all right. So at the margin, this may help, but will not do quite enough. The pension thing, right? I mean, it's just one constituency in that sense.
Yeah, because the government can't afford to keep sitting on its heels. They are 240 in the national parliament, and if they lose some key states, they need to be acting, and that's what I see as a positive for this government. At least they are proactive. They're trying to course correct. Now, whether that course correction will help or not, nobody really knows the answer. But at least they are reactive, which they were choosing not to react in the run-up to elections.
Indraneel, let's come to the wealth effect. So, first of all, a lot of this will only start to show up post-2000, approximately 39-40, right? Because for those who joined after 2004, right, who entered service after that. But do you see this leading to increased spending in that sense? Because would people have not spent on a car or something on the wedding because thinking, well, the pension is lower? I mean, I'm just trying to understand what will this do for employees here and now over the next couple of years?
See, the fiscal cost is 2040 plus.
Yeah.
But the wealth effect is immediate. In the sense that, earlier you were staring at a scenario where you would get only, say, 20 rupees to live your life beyond retirement. I mean, this is assuming you live a while. But now you see that going up to 80. So the savings that you were having to make on, your retired life, now you can spend that today. Invest that today, maybe, whether it is in a house, whether it is in a better car or whatever. So the point I'm making is that, the impact on the fisc is going to come much later, but the impact on individuals' sense of well-being is going to come right now.
And typically something like this shows up in which segments? Which sectors or subsectors?
So I would think that housing is the biggest one, because the government housing loan is also very limited given the current market prices. Cars could be another. So housing, that gets to its whole interrelated sectors of cement and so on. But then I think that is where most of the wealth effect that civil servants will get will go.
Got it. Gentlemen, a longer chat, but later. Thank you very much for joining us with an interesting sort of perspective on the pension bit and, of course, politics as well. Indranil, good to speak with you in the new avatar, and here's to many more. And Sanjeev, always a pleasure having you with us here on CNBC-TV18. Thank you very much. We'll take a quick commercial break here. We are back. We'll focus on... Okay, I think we'll go to Mitesh and just ask him for his view on what the market is doing and any fresh trades he might have. Mitesh, over to you.
So, Prashant, I think the market has recovered very nicely. I would have preferred a bigger dip to buy into it, but then it's okay. The direction remains on the upside. I have a buy on ABB. That's a buy with a stop below levels of 78.10. Look for targets of 8,050 to about 8,100 here. And the other call is GNFC, which I would recommend buying with a stop at 674 for targets of 710.
Okay. All right. Got that. Mitesh, thanks very much for your calls. Market is managing a 20-point up move, which is perhaps not bad given the kind of cues that we started off with. And the mid-cap screen is looking even better, 0.5% up on the mid-cap index. So it's literally up and away. Remember, yesterday we were talking about a move on Tata Elxsi. Well, guess what? That's happening again. There was a 9% sort of upward thrift yesterday as we were closing out, 6% this morning. GSPL's run has not stopped at all, still up about 5%. It's off the highest level of the in the opening high, but it's still up about 5%. Subros is up about 7.5%. MediAssist continues to run on that acquisition. So the short point is that the broader market, look at Tata Investments, by the way, up about 7 to 8% as well. So lots of stocks buzzing around on the broader market screen. We'll take a break on that note, come back on the other side. And then, of course, we'll discuss commodities with Manisha Gupta. Welcome back. It's time to talk commodities. Let's go across to Manisha Gupta. So much going on, Manisha, with geopolitics, and all these issues. Now, Libya's shutting off crude output. Tell us, what do you have your eye on? Starting maybe with oil itself?
Oh, well, yes. The crude oil prices, last evening's or last week's decline was at around 76. We're trading at 81 right now. So $5 of a gain in 5 days is what crude prices have done. But with the kind of decline that we've seen happen in US dollar index, the expectation that the Fed rate cut will now happen also seems to be supporting the base metal prices in a big way. Remember, the month of June and July were not so good. But the month of August clearly seems to be ending on a positive note for many of these metal prices. We have seen improving Chinese demand at lower levels as well. China did not buy metals at higher levels. But with the kind of declines that we've seen in many of these metals, 18 to 20% off their highs, there is buying in China that really seems to be happening as well. And as I was telling you, there are hopes of a US rate cut in the month of September. The US Fed would be doing it the first time, but we also have seen other banks do it. And the expectation that more global central banks would be cutting rates yet again in the month of September has been supportive for many of these asset classes. The markets also are looking at US imposing the sanctions on non-nickel subsidiaries, and that could really impact supplies for many of these metals, which also has been supportive. So Nornickel's subsidiary Bistrinsky does produce a lot of copper and gold. It also does iron ore, and we've seen some premium build up into many of these metals because of this one news as well. So if you look at the copper prices, we are trading at a 5-week highs right now. For the month of August, we are 4% up in the month. Aluminum prices also are trading at a 5-week highs, and it has been an outperformer when you look at metals as a sector. 12% up in the month of August, and we are trading at a 5-week highs. Alumina shortage, stronger demand, higher imports from China are supportive factors. Zinc also has been gaining quite strong. There are concerns and there are a lot of consultations as well on cutting output going forward in zinc, and that has been supportive. We've seen prices gain up by 15% in the month of August so far. Also, when you look at the kind of lows that we saw in August for zinc was at $25.88. We are trading at $2,900 a ton at this point in time. Strong support also has been seen in case of steel as China looks at cutting output. Iron ore prices have extended gains, hitting $100 a ton. Prices are up 4.5% in the matter of previous week itself, and the China port stockpiles have continued to decline. The one data that the street will now watch out for is the China PMI manufacturing data that comes in tomorrow. That would give you further direction.
All right. Manisha, thank you very much for that. That's commodities in focus. Markets are flat, 5-point change on the Nifty. We take a quick commercial break here, and we're going to come back with an interesting conversation. My colleague Lata will be speaking with Vetri Subramaniam, Chief Investment Officer at UTI Asset Management Company, and they talk about the first quarter earnings, where earnings are going from here on, top sectoral bits, and what after new highs on the Nifty. Stay tuned.